It is pretty warm out here. And I just want to let you guys know I'm out on bond. Hey Ross World, my money makes money. I'm out on bond, or rather, I'm into bonds. I've never been incarcerated, thank God. But this is the thing. The financial service industry will have you to believe that everything is complex, everything is serious, everything is over your head. You have to go to years of training, years of schooling to understand bonds. Okay, what are bonds plain and simple? What are bonds plain and simple? Bonds are loans. That's all they are. Bonds are loans. So when you buy a bond, whether it be through your portfolio, your asset allocation, through Wealthfront, Wealthsimple, Stash, even if you did it through Robinhood, Acorns, etc., they are loans. Now you have different types of bonds. Okay, you have different types of bonds. Take for instance a government bond. A U.S. government bond is a bond to the federal government. So you're loaning money to the federal government. Now let's get on the returns of this. Now anytime you do a government bond, statistically the return you get for your money is only 1.8 interest. But let you take out a loan with the government or a school loan, okay, what the interest rate is going to be. Now, primarily is low, but some loans we know, you're like, I got a loan for 8 or 10%, and some of you even 24%. Okay, so that's a government bond. Now, you also have your TIPS, that Treasury Inflation Protection Securities Bond, okay? So what is that bond? And I did a video on that. You'll have to look that up, guys. So a TIPS bond or a inflation protection bond is when inflation goes up, so does it. When deflation happens, it goes down. Plain and simple, right? Plain and simple. What is a municipal bond? A municipal bond. And you heard that word municipal before. Municipal is a bond or a loan, right, to a city, state, or county. A city, state, or county. A municipal bond. What is a corporate bond? A corporate bond is a bond or a loan to a company like Microsoft or Intel or Google, a corporation. Then you have your high yield bonds. Now, they call these either high yield bonds or junk bonds because these are bonds that you buy for companies who just starting up, who doesn't really have a lot of revenue, who is not steadfast in the game, but has high volatility, almost like a stock, but is a bond. But this is the difference between a stock and a bond, though, when you really get into these. You say, why would I do a high yield? Because the interest is higher. The lowest interest you're ever going to see on a bond that you'll receive back, don't forget, the interest I'm talking about is not the interest you pay, it's the interest you receive. And what I'm talking about, say for instance, I said the government bond is about 1.8%. Now, when you get that money back, they're going to give you the money that you bought into the bonds and also your interest. Now, the junk bonds or the high yield bonds have a high percentage. Now we're talking about 4, 5, 6% depending on that bond. Why buy a bond anyway? Asset management, asset allocation, diversification, all of these things. Now, bonds alone helps, but not always, your diversification. Like, what the hell is he talking about? So everybody's talking about diversification. Now, no one can time the market. No one can predict the market. But the cool thing about this is, if you are young, 20s, 30s, 40s, you can be a little more riskier and you can invest your money more into U.S. stock, emerging markets, foreign stocks, etc. But as you start to get older, you want to start tweaking your allocations more into bonds or more security. You're saying, why do you say that? Now, high yield bonds is a different story because if a company goes out of business, if they go bankrupt, you're not going to get your money back. But bonds pay 85% of the time. You say 85% of the time, believe me, that's high in the financial world, okay? That is high in the financial world. This is a cool thing about bonds that you can't do with stocks. When you do a bond, because it's a loan, they have to repay you legally. I'm going to say it again. They have to repay you legally, okay? So that means if they don't pay your money back and they're not bankrupt, you can sue that ass. you can sue that ass. So understand that a bond has to be paid back legally. So what's the highest chance of you getting your money? The U.S. government, the federal government. Now, we probably owe China some money. You know what I'm saying? But in the end of the days, when it comes to foreign bonds and U.S. bonds are the safest bet. But in any asset management company that you have your money that you're diversifying, they're going to do it through all those, even tips, because tips helps you with what? It helps you with inflation. So understand the different types of bonds, because what's the purpose of me giving you guys all this information, telling you put your money here and put your money there, put your money here, where you don't even know what the hell you're putting your money into? Because it's very important that I teach you guys and I tell you guys about all this money and what does it mean. Because in the end, you're like, well, I don't know what a stock is. I don't know what a bond is. And I talked about stocks early in some of my early videos that you can go and you can get educated on. Okay, you can get educated on. But now we're talking about bonds and the different types of bonds and how those bonds secure your funds. Is it a chance you still can lose your money? Yes, indeed. But this is the thing. It's a safer bet than stocks, especially as you guys get older, as you become more conservative, okay? Now, midlife, you kind of want to be balanced between stocks and bonds. When you're younger, you're trying to increase the potential for growth. Okay, you're more aggressive. But as you start getting your 50s and 60s, you're getting close to retirement, or you're in retirement, then you want to be conservative. That's when you want to allocate those money into more bonds and index funds, okay, guys? Not so much individual stocks, because really every individual stock it has some sort of volatility that you can lose a lot of money on. And no one can predict the market. Right now, we're in a bull market. Yeah, it's up and down, but it's pretty much a bull market. And no one can predict it, but I'll tell you this. Over the course of time, every 10 to 8 years, which we have surpassed that, a bear market comes where the market is losing anywhere to 40 to 70%, but don't sell. Now, some people will have you hedge your stocks if you're in that sort of type of thing, but there's different ways to diversify your money, different from bonds and stocks. We'll get on some more of that information later, but this is just to let you know all about bonds. I'm not out on bonds, I'm in on bonds, and so should you. And hopefully I broke it down simple enough for you guys to understand. This is Ross World, where we're not held out on bond. We're not out on bond. We in on bond, and we need to understand bond. And now me and you, we have a bond. I'm out.